Hello and welcome back. So this time we'll have a very interesting diversified overview of different markets with EM. We brought specialists which are experts in their own regions. So I think we'll make kind of like a puzzle and see each market in details. So we'll have Sandeep Jadwani starting with asset allocation to fixed income and bonds on MENA market. Sandeep, welcome. Thank you for joining us today. How are you?
Lovely. Thank you so much. And, I thank Cbonds for bringing this and being resilient in ensuring that the event goes on and the show must go on. So from a face-to-face to a more online, I think it was just in time that everyone.
Sandeep. Yes, so today we'll discuss MENA market in details. Later on, we'll speak with Meritkapital, Persella Ioannides, the director, and Jindu, covering Sub-Sahara Africa. So we'll speak about the African market as well. I believe we'll then pass the floor to Artem, covering Artem Kormilitsyn. He's the CEO and head of capital markets Asia Pacific in GPB Financial Services Hong Kong, covering some China offshore market and what kind of opportunities we have in terms of Chinese local currency as well. And later on, we'll have Terry Zhang. We'll see more the overview of Panda Bonds. And I believe the last speaker would be Gonzalez. He'll join us later on, covering the Latin American bond market. Sandeep, are you with us?
Absolutely, I'm here now. Hi, sorry, some disconnections on my side.
Okay, then let's probably move as the agenda goes with your presentation.
So, an inversion yield curve is typically a sign that investors are worried about. And the economy and recessions have followed when yields on two-year treasuries have risen above those of the 10-year. We can see on this slide that I put in that every time there is an inversion, it is followed by recession. That part of the yield curve has so far, it's almost inverted, although the gap is narrow as well in recent terms. So this being the backdrop of our fixed income asset class, I dig down deeper on why from the global bond asset class, why a regional perspective is much better suited. Okay, we all know that I can't change the slide. Okay, so asset allocation to GCC's fixed income, as what I'm covering today, the contents are more to do with what is the global state of what's the state of global bonds as an asset class. Why GCC fixed income market is more suited towards paying attention to what are the opportunities, the risks, and in turn, what is the overall view as to what should and how much should be allocated to the GCC market as such. So moving to the next slide. The bonds have not been favorites of late. If you see in 2021 and 2022 till date, bonds being more defensive, they have been negatively performing. The reasons are very clear, which my colleagues before had mentioned, Mohammad Ehsan as well as Amr. Inflation in 2022 is at 7.9%. There is aggressive rate hikes, already in place where the central banks are front loading these hikes. We expect almost 11-25 bips hikes until the end of 2023. We could see very high pace of 50 basis points rise in quick successions. Also, one of the last thing is liquidity. We would see money supply being reduced. Quantitative easing is ending and tapering will start from March, which is this month onwards. I think there would be no more new bond purchase, so no more inflation or inflating the balance sheets of the Fed. And all these factors not only impact treasuries, but they impact most of the fixed income securities and bonds across the capital structures. With the risk on sentiments on, there could be possibility that high yields perform much better than IG, but eventually as risk off sentiments play up, the trend could reverse. Moving to the next slide over here. This is a review of how GCC has typically done across asset classes. GCC consists of 6 countries, which is Kuwait, UAE, Qatar, Bahrain, Dubai, and Saudi. The green line, which is the equity performance or the overall blended GCC equity space as marked by S&P GCC index. Now that has been YTD 10% plus. Factors definitely include having enough liquidity, oil prices being up, vaccination drives at a very aggressive pace, and a lot of reforms within these countries that come up. On the other hand, when we see what the bonds are doing over here, the GCC bonds, you would see barring the first 4 months or until mid-year 2021, they were in a positive territory on their own. But towards the end of the year and YTD, they are typically a negative of 6%, 4.4 YTD, and previous negatives as well. So though a very busy slide, but that's the difference that comes through. However, on the next slide, when we look at comparing the GCC bond space to the peer group, which is MENA, which is Asia, Latin America, EM, hard currency, we see a totally different story. That GCC bonds, whether high yield or IG, have been very resilient to the downside. So we see in this performance is only until 2021, the whole of 2021, where though we see Latin America, a sovereign index being negative of 5.29% for the year, but GCC sovereign is in a positive over 1.25%. So though not huge, but they are usually more resilient within their peer groups. Also, when we look at US Treasuries, being the safest of all, GCC bonds have performed much better than them, despite we know that there's a risk trade-off over here as well. The risk does not the returns does not commensurate for the risk that we take. But in a way, they've been doing their jobs pretty well in terms of ensuring there is a return coming out, though no real returns here. And on the next slide, I'll look at certain the size of the market for fixed income market of 2021. Typically, the total size of GCC fixed income market is about $540 billion. That is almost 12 to 13% of the overall 4.5 trillion EM bond, hard currency bond market size. Now, when we look at what happened last year in terms of issuance versus maturities or redemptions, we see there was a net of 52 billion approximately in terms of net issuance. The book size or the oversubscriptions overall were at 4x, which means there's good uptake for high yield or within the EM space in the GCC. Though this year in 2022, the primary issuance would be muted as interest rates go up. So within the capital structures, companies or sovereigns don't want to raise at a higher rate. We could see some impact happening on the secondary market because of lower issues. The secondary market could get very active, and this again would be a point to ponder upon, that the pricings, though very rich at the moment, will stay fairly stable when it comes to on the shorter end of the duration spectrum. Um, um, it is interesting to see that within this space of $540 billion on the GCC, approximately 20% is the Sukuk space, which is highly demanded within this part of the world. And Sukuk subscriptions usually were oversubscribed by about 5.1x, which is a huge increase over the past years. Okay, and moving on to the next slide. Where does the opportunity rise? Sorry, it's a busy slide, this one. I've put these points so that we can really visualize as well as to what are the points or what are the key determinants of this opportunity within the GCC fixed income market. Personally, I have been in the GCC for over 10 years. Earlier, I had never paid attention in the beginning of my career, never paid attention to the GCC credits, though other EM credits like the BRICS or the next BRICS were too much in demand. But since the inclusion within the MSCI Emerging Market Index and other things, GCC today forms a 12% allocation within the EM fixed income mandates. As an index, which is huge compared to what it was 6 years back. So the factors that provide fundamental support to GCC purely is number one, higher oil prices. Oil prices above the $70-$75 will definitely put this region in the forefront when it comes to bonds. Okay, because of oil prices being high, this will reduce their fiscal deficit, or even in some countries within the GCC, there will be a fiscal surplus. One of the major components within the region is that USD is, the local currency is pegged to the US dollar, which itself is a huge advantage, and there are no capital controls as such, unlike other countries like China, India, or Egypt, where there are capital controls and the currencies are fluctuating. So whether it's hard currency or local currency, the GCC bonds really play a major role in terms of providing that stability and doing away with the currency fluctuation. Within the usual GCC blended investment grade and high yield bond index spreads are at 150 bips, which is very attractive given the risk appetite of or risk measure of these bonds. Within these countries, we also see huge structural reforms happening, inclusion of VATs, corporate tax, which will open up the financial books of these companies, which were usually not open to all. The ease of doing business within this part of the world, opening up businesses, traveling in, the new reforms in terms of providing golden visa, 100% ownership of companies by expatriates. So these are improving factors that give a lot of confidence to international investors. Locally, the demand is there, but the juice of uptake comes in when international investors and mandates look at this region for more seriousness. I personally believe that the GDP growth rate at that IMF projected at 4.2%, it is more modest than more aggressive, but still healthy compared to the rest of the world. The size, as I mentioned in the beginning, the size of this market is in excess of $550 billion. And this has increased from around $200 billion in 2015 or 2016 till today at 550 billion. Despite what we've seen as the pandemic drawdowns, we've seen huge volatility in terms of the pricing, And another important point that comes in, which everyone is talking about, are the ESG mandates. We know it's made headlines across the world that Saudi Arabia and UAE have pledged to become net zero in terms of their carbon initiatives by 2050 and 2060, though a long way, about 30, 35 years from now. But it's the first step towards that. As ESG becomes more core to investment thesis and mandates, I think a lot of money will flow into this region as well, within the EM space. A full spectrum of solid yield curve establishments have happened for benchmarking, which wasn't the case before. Earlier, there was no benchmarking that happened. There was no yield curve within the region. The benchmarking was it was a quasi benchmarking that was happening. However, this region provides a higher coupon uptake, primarily a region that is more inclined towards REITs or rental incomes, and hence for any subscription to be accepted well and to be taken well from the local or regional players, it is important that they provide a higher coupon. And hence, the focus within the GCC markets are usually coupons and longer duration. Okay, so these are certain pointers that form the basis of the thesis of why we should typically look at the GCC fixed income market and not ignore it completely. This is the opportunity. However, no opportunity comes without any risk. And there are certain risks that underpin why we should be wary of the facts in terms of investing. On my next slide, I will discuss about certain risks that come through. Sorry, just let me know if I'm too fast in the comments. I would like to take as many questions as possible, and hence I'm rushing through this as well. Okay, so. One of the major risks is inflation risk. We cannot deny that. Okay, we cannot deny that the Feds or global central banks thought they were ahead of the curve or with the curve, but they are actually behind the curve until a long time where inflation was transitory, but now it is mainstream. This becomes one of the major risks. However, policy changes, which includes front loading of interest rates and rapid tapering, may impact financing channels available to these countries within the GCC. Supply chain disruptions, more than supply of oil, I think it's the supply chain disruptions and security of the supply that will create havocs. We don't want to see any major attacks by Yemeni Houthis or within the Zanzibar region of oil tankers being hijacked. So this again is one of the major issues circling around region, because oil itself is their major commodity. The Russia and Ukraine geopolitical spillover could have impacts within this region as well. I can't stress enough on the seriousness of this issue, but it's really something that we should consider. We recently even heard about re-emergence of newer variants in China that could dent the recovery, negatively impacting oil demand, and hence the price could go down. So more or less potential Chinese meltdowns impacts as well. We're seeing COVID variants coming through. We're seeing lockdowns happening. The Evergrande and the real estate meltdowns, policy missteps that were taken in Turkey and China, which will impact external investments as well. And on the other side, from this year onwards, there are very limited sovereign or financial sector primary issues that will come up. So a lot of monies will rotate within the secondary market. And since the bond market is an OTC market, we could see a lot of mispricing in terms of the bond price. So these are major risks that come across. What I would suggest on my next slide, it's again a personal view in terms of how do we conclude and place these bonds within our portfolios. Diversifying and not chasing high yield, because Bahrain and Oman within the GCC are high yields. They do not act and they do not function like bonds, but they do function like equities. 20-30% pricing up with 6 to 8% of coupons. So don't get attracted towards high coupons. There could be a lot of shocks that will come through if you're leveraged. So the GCC is a high quality long-term EM. The steps that these country leaderships is taking to diversify away from oil and increasing their healthcare sector or financial sector or infrastructure or even tourism. They are mostly guided by tourism. Since the GCC fixed income market is denominated in USD, it is absolutely clear that you could take as a USD exposure itself, since there are no capital increases. The strength of the energy sector, which is oil and gas in Qatar and oil in Saudi and Abu Dhabi or UAE, serves as a natural hedge to inflation. Wherever the inflation goes, inflation will be hedged to a certain limit because of oil pricing. And GCC is tackling the ESG challenge at a very rapid pace. Forerunners in my previous slides, as I mentioned, were Saudi Arabia and UAE. So as we get more clarity on what the ESG mandates would be, I think, in my opinion, GCC will be one of the top regions where the monies would flow in. Now with China and Russia, within the peer group being slightly unfavored purely from a ESG perspective, I think GCC will be the winner here. We already have seen how Egypt has taken advantage on issuing green bonds last year. Compared to other EMs, GCC fixed income paper or credits usually offer higher coupons. They're usually mispriced or inefficiently priced. Our sovereign fiscal balances will support the credit profiles. This typically happens because oil is the guiding factor towards fiscal balances. Budgets do allow and support economic growth, which should benefit spreads relative to their markets. And as valuations have improved, because spreads have widened as well, absolutely realistically doing the math. And it's very important that we be selective and be flexible as and when needed. Not overexposing to the region, but definitely taking that extra step ahead and being slightly dynamic in the approach would be the key factor over here. Okay. On the next slide, I have a very small thing that comes in, which is a thank you note. Thank you for patiently listening, and I'm happy to take questions from you.
Sandeep, thanks a lot for your overview. I actually have a question for you. So how do you think, to what extent do Middle East bonds remain protected from foreign policy risks, given the tense situation in the market and in the world in general?
So, Lana, it's a very good question. But in my personal opinion, the GCC market will be well protected from reforms across, because GCC as a whole, they've tried to be more accommodative when it comes to Israel, Iran, within the GCC, even within Qatar, the embargoes that happened, they've been very accommodative and they've come out to clear up most of the differences. Though we see that the EU from time to time puts across a grey list and puts GCC within the grey list of companies, but I think it's only temporary to protect investors within the region, and it will be more resilient to most of the global reforms, because GCC is poised to make an impact in a positive way. They are more inclusive when it comes to their approach. A very small example over here is Saudi. How in the last few years there has been a paradigm shift in the way the Saudi leadership thinks and how they are the community is moving ahead. This is on a very a ground level thing, but even at top level, though there would be a lot of tug of war in terms of political flexing, particularly from an OPEC perspective, but that is predominantly needed to ensure the incomes coming through and surpluses coming through.
True. Thanks a lot, Sandeep, for your overview. I think let's move to the next speaker, and in case we have more time, we can make a few questions and answers as well. Thanks a lot, and I'm passing the floor to Persella Ioannides and Simba Jindu. Persella is the director of Meritkapital, and together with Simba, they will he's a sales and trade active for Sub-Sahara Africa, so they will make the overview for the African region. Persella? Simba, are you with us?
Yes, good morning or good midday, depending on the time zones. Thanks for having us today. My presentation or my contribution will be rather brief. Simba is the expert really on the region, so I will let him take the presentation if okay.
I would say we had Meritkapital. They're actually based in Cyprus, so they attended our conferences in live mode. It's rather curious how African market is now performing, and as you could see on previous slides, there are some interesting names as they are recovering rather in a high way. So let's see if we could find some additional contribution to this overview. As of now, I just want to remind our participants who are listening to us, feel free to leave your questions as this is your key moment to get some names maybe or get some answers to the questions. These are the experts who know the market from inside. We have our speakers from all around the world, sitting in Dubai, in Paraguay, in Asia, Hong Kong. So feel free to.
Okay, I think set up now. Thank you very much, Lana, for that brief introduction of us. Good to know at least we have a presence that you still remember out there. Yeah? So this is us, Meritkapital, and I'll be presenting on Sub-Sahara Africa, the Eurobonds. So just a brief overview, just to add on to what Lana was saying. So we're about 16 years now in existence, and we've gone from strength to strength. And the latest ones being the setup of an office in the UK. And as a testament of focus on Sub-Saharan Africa, we're actually setting up an office in Nigeria to trade local currency. So that's one of our latest achievements. We hope to set up there and trade local currency. And so I think I'll move on to Sub-Saharan Africa. So for this presentation, I'm going to exclude South Africa. So even though we have South Africa there on the slide, I think South Africa is quite a developed economy, relatively speaking. It has quite well-developed industry from primary up to tertiary industry. So for the purpose of this presentation, I'll exclude South Africa. So initially at the start of the millennium, we had quite some massive growth all around. So there's some numbers there. We had about 5% first decade, and then the second decade, the 2010s were a bit slower, but all the same, we have Sub-Saharan Africa presents quite a number of countries that are having outsized growth. So as you can see there, I just highlighted some of the countries. We still have quite a number of countries having growth above 6%. I think more familiar ones will be Ethiopia, Ghana, which I'll focus on later on. And then to the other end, we also have Angola, which I'll also talk about quite a bit later on. So it's quite a mix of countries. Growth is still quite high, I think, relative to, say, developed economies, even pre-rebound from COVID. So yeah, so as well, what we've seen previously, I think for those who attended the 2017 conference, we had then, I think the total amount outstanding was about 30 or so billion US dollars. And since then, I think more countries have come to the market and have issued more bonds, and I think that's one of the challenges that's leading some countries. I think we'll discuss it later, but some countries right now with the whole debt problem, because previously it was mostly bilateral or multilateral funding. And that comes with quite a lot of restrictions on what you can use the money for. Say, if it's the IMF, very stringent conditions, they only disperse more if the country is seen to be sticking to what it initially said that the funds would be used for. So Eurobonds, it's just investors believe in your story. There really isn't as much of a restriction. So as you can see here, we have quite outsized borrowing from Nigeria, Ghana, and Ivory Coast. Then as well for Angola. Those are the countries with quite outsized growth. Out of this, about 64 billion pie. And most of this dollar denominated, about 80%, as I highlighted there. Euro issues are few and far between, and I think outside South Africa there isn't. It's just euro and dollars. I think South Africa has some yen bonds, so it's just euro and dollars, and euros are mostly by the francophone countries. So these are mostly previously French colonies, West African countries. You have your Senegal and Ivory Coast. Those are, and maybe Gabon. Those are the countries that have some euro-denominated issues. So it's mostly dollars. So yeah, so it had been a growth story, as I indicated previously, the decade up to 2019, and then we had COVID. So Sub-Saharan Africa being mostly dependent on commodities. So this was quite a bump. And as well, tourism. So, for example, countries like Tanzania, Kenya, those took quite some heavy hitting that year in terms of economic growth. And as well, we go to Western Central Africa, where we have most of the oil producing countries. That also took quite, that also hits the fiscus quite heavily. And so, broadly speaking, what COVID did is it it produced a dichotomy in the country's economy. So we had quite outsized spending as governments tried to shield citizens from the impact of COVID. But at the same time, you also had a very reduced revenue collection. So for already as it is, revenue collection is quite a challenging area for sub-Saharan Africa countries. If we take Nigeria, for example, Nigeria is a mostly informal economy, for one. So what COVID did is it reduced the number of companies, this is in the formal sector, from which governments are supposed to be collecting taxes as well as their revenue. So that took quite a beating. But at the same time, governments had to subsidize and put so much spending in maintaining the social fabric of the country. So that, if you check for most African countries, we had quite an increase in your debt levels, debt to GDP especially. So that as well has played out. I think the impact is really starting to be seen now, as we're seeing some countries, they've basically been shut out of the market. You can't go into the market to borrow. Take Ghana, for example. Ghana, the last issuance they had, they were issued, I think, about 10-year paper were issued at about a yield of 8 point something. Now the same paper is in the mid to high teens. So they effectively shut off the market and they can't easily get back in. So that's the case where in just Ghana is a prime example of this. So going on, I think we can start some selected country analysis on these. So Angola, I'd say this has been one of the recovery stories of post-COVID Angola. So going into COVID, Angola is highly dependent on oil. And we all know what happened to oil during COVID. And as well, unlike most of the other sub-Saharan African economies, Angola was already in recession, starting as way back as 2016. So it was a double whammy for Angola there. And as well, Angola had quite a hefty debt burden with the Chinese, in addition to Eurobonds. So what we saw for Angola is, I think it went into near default. Pretty much the whole region, we had bonds tanking, but for Angola, it really went into distress level. So even comparing with the other names, Angola was trading, I think, about 40 at one point, to 40 cents to the dollar for every bond. So afterwards, Angola benefited quite a lot from DSSI, as well as I think China as well also provided quite a bit of debt relief. And immediately after COVID, oil went up for the fiscal year 2020 to 2021. They had set up their budget with the target level for oil at 35 per barrel. And we know last year oil really went up. We get into the 70s. On average, it was way above it. So it really helped their fiscus. And 2021 is when the recovery in Angola really materialized. So we had the country officially get out of recession, and as well, their debt levels really came lower. So they're now sub 80, I think about 79% in 2021, the debt levels on Angola. And as well, as a testament to how well the market is now viewing Angola, I think they're now in B level. They're now rated B. And early analysis by most street players had Angola as one of the overweight names. So this is a developing story, and I think they hope to issue they hope to issue a Eurobond this year. So going now, Ghana, that's a totally different story, a complete polar opposite of what's happened in Angola. So where we saw Angola moving from a point of weakness to a point of strength, the reverse has happened in Ghana. So in Ghana, mid 2010s, they were under an IMF program. I think they went two actually. The last one I think ended, about 2019. And afterwards, because of the whole IMF support, investors really powered into Ghana, and Ghana could easily come into the market. Just 2020, just before I think March, they issued their issuance was quite oversubscribed. I think 3 times the amount they actually wanted, and they got that much of a subscription. So, but now what's happened is, because of all this, what I was mentioning before, governments having to spend quite a lot to keep to support their citizens during COVID, we've now seen quite a hefty increase in debt levels. So now Ghana, as a 2021, debt to GDP is now 80%. That's super high. And as well, they actually wanted to issue a social bond in 2021 before markets sold off in late 2021. They could not even issue, and even now they're still hoping to come to the market and get a syndicated loan. So they can't get access to Eurobonds. Now they still have to borrow more. And for them, it's a case of political will. The IMF, as you may well know, whenever it engages a country on a program, they're very strict about certain things. And that's what the current government is not keen on. So they're trying to find ways to go about it, but not with much success. More recently, they're hoping to put a tax on mobile transactions. So mobile money is quite a big thing in sub-Saharan Africa. Most of the population is not formally banked, and what telecoms companies have done is to set up mobile wallets where pretty much you have an account linked to your phone number. So that's what the government is hoping to leverage on, tax those transactions. But while politically, it's not seeming as if it's going so well. So that's the case of Ghana. I think now it's rated almost in CCC. I think Fitch has it in CCC already. Other ratings agencies are likely to follow. So that's one of a not so good story, SSA. Then going to the next one, Nigeria. It's a curious story, this one, Nigeria. It's the largest oil producer on the continent. Oil makes up quite a lot of the revenue. But what keeps them back now is subsidies on petrol. With Nigeria, the curious thing is, even though they produce quite a lot of oil, none of it is refined in Nigeria. So it's shipped out, and then they have to buy back the refined product. So that pushes up quite a lot of their costs. And as well, to keep produce such a low, whenever they consider setting up, like doing away with subsidies, there's always protests, and so there isn't that much of political will for whoever is ruling at that moment to really go in for the subsidy. So oil now, because oil is trading in the hundreds, it puts quite a lot of pressure on the fiscus. So estimates of the subsidy bill, I think the latest estimates from the government say about 7 billion. Some put it as 3 billion, so that's quite a lot, 3 to 7 billion a year on just petrol subsidies. But one thing there for Nigeria, the debt levels are quite low comparatively. So you have a B median about 68%. That's 68% of debt to GDP. For Nigeria, this is 35% as of 2020. I think it's just about 40% as of 2021. Official figures aren't out yet. So it's one of those stories where if there is something that should happen with the subsidies, it is a very good story there in SSA, the Nigeria one, just as a testament to how much the market still believes in them. They had an issuance this March, and regardless of where debt levels are, they came to the market and they still had quite some demand on their bond. I think they had a book of about 4 billion. They issued 1.25 on the 8-year paper they issued. So still some bit of demand on Nigeria, regardless of what's been happening. And the last country we're going to be looking at, Zambia. So this one has the very unflattering reputation of being the only Eurobond default for sub-Saharan Africa during COVID. Most of the other countries, regardless of the pressures COVID put, they might just stick to their debt payments. Angola defaulted late 2020. And one thing is, the government, there's a new government now. It got into office last year, 2021. So the previous government had been in talks with the IMF for a program since 2017. Nothing had come of it because the government would always renege on promises they would have made, and there wasn't as much will as well to stick to the goals IMF was setting up. So post this default, we've seen that the new government has also come in. It seems to be quite pro-business, and they've stopped all the fighting they were having with the miners. So as a result, there's investment coming in for copper. It's the second largest producer in Africa for copper, and with the commodity boom, that's really did wonders on their reserves. And as well, they agreed in principle with the IMF for a program about 1.5 billion over 3 years. That's only pending some restructuring with creditors, and once that is done, the IMF board should then approve. So that's just about sub-Saharan Africa in a wrap. We just had a couple of countries we figured are noteworthy there.
Simba, thanks a lot for your overview. Can you comment, what are the main sources of financing for companies which are operating in African market, and how much these markets are exposed to macroeconomic risks such as fluctuation of food prices, energy resources, and stuff like that?
Okay, so for most companies operating in the region, depend on local financing. For companies specifically, they haven't really pushed to move into the Eurobond space. There's much of that. But though, we have, I think Nigeria is more developed in that respect. We have quite a number of Nigerian banks that are already in the market. So, and for this company, in such an environment, I think it only helps them because we have a commodity boom, right? I'll take Nigeria for example. most of the banks in Nigeria are exposed to, their loan books are exposed to oil and gas. So what happens in such an environment where oil and gas are on the boom? Their books only get better. For if you can look, say, for at some of the Nigerian banks, for example, the sell-off compared to the sovereign has been much less pronounced, because their books will only get more profitable in such an environment. But as I mentioned earlier, for the sovereign, the country itself, the boom in commodities, say oil, only hurts their fiscus because they have to pump more towards subsidies. And even for food, Nigeria doesn't have as big and as an agricultural industry, so they also have to fork out more for food. So for the companies, I'd say this serves them well, getting financing, be it in the local market or even coming to the Eurobond market. Suppose that's it, just for the companies that are operating in the region.
Thanks. And can you specify what are your, how do you highlight what kind of countries are more promising for your point of view? What are your strategies as of now?
Okay, I think the main strategy we have is to pick on those weakness to strength stories. So specifically Zambia and Angola. Zambia, for example, Zambia is trading, the bonds are trading about 69, high 60s, low 70s cents to the dollar, and restructuring. I think most analysts estimate that we should have a haircut of about 20%. So it's quite attractive at that level. Once it goes beyond, say, it starts creeping towards the high 70s, post 80, I think you're stretching it quite a bit. So Zambia is one of the names I'm looking at. And we're also looking at Angola. Like, it's another weakness to strength story there in Angola. Outside of that, most of the names, not so much. And then I think I could add as well Nigerian banks. So fortunate that this presentation was mostly focused on the sovereigns, but Nigerian banks are something you can look at. So even in this volatile environment, they hold up quite well. And as I mentioned before, their loan books will only benefit from such an environment.
Sorry, Lana, if I can also make a comment here. Basically, we're seeing a global bond sell-off, which is, as we all know, mainly driven by the hawkish global central banks. And what's beneficial about Sahara, or just generally high-yield commodity-linked debt, is that they generally trade at wide spreads to core yield. So let's say the volatility tends to be less pronounced. So, I mean, going back to your question, I think, just the way that I think the market is generally trading fixed income right now, commodities seem to be performing well. We don't know how long the Russia-Ukraine situation will continue, but even if that subsides, most analysts have pretty high targets for oil, irrespective. So they see basically a mean price of at least like 95, let's say, for the next 6 months. So let's say commodity-linked bonds are in favor. And most of the market wants to be placed in shorter duration to, circumvent the volatility, or at least in high-yield bonds for the widespread factor. If you look at Nigeria, you were asking, what do we think of corporate bonds, etc. I mean, Simba was correctly answered that outside South Africa, the corporate bond market in Sub-Sahara is generally small, and it's generally focused on Nigeria, which is mostly banks, and again, oil companies such as Seplat. The banking sector in Nigeria is quite strong, and most of the bonds there are generally of short duration, so they're about 7 years at most. And we've seen during all this volatility now in the bond markets that they've traded pretty well, pretty steadily. The other point that I will make, as far as stories in the regions are concerned, one thing that I would like to add on Angola, why it's been a good performer, is yes, during the COVID crisis, it traded at extremely low valuation. So holders who had it at 100, all of a sudden were looking at 30 cents to the dollar during COVID. And one of the reasons is okay, as Simba said, the break-even point for producing oil is quite high, and they were already, let's say, in the beginning of a recession. But it's also as we all know, it's a very oil-linked economy, and with oil prices so low, it was quite heavily impacted. But at the same time, the government was basically very strictly abiding to the IMF program. And once the IMF signified their support during COVID, you saw valuations steadily jump from there. They haven't come to the market yet, so I mean they have their fiscal picture quite in control, and so my point is that stories in Africa that are backed by multilateral facilities such as IMF or lending from governments such as China are bound to perform well. So Ghana right now is let's say one of the weakest performers, primarily because they took advantage of the situation when they could come to the market, and when IMF support was there, and when it was pulled, they were left with a very high debt situation. But now, let's say, and also the government now is not very keen to embark on an IMF program again. But again, if there's a change of regime, if there's a change of inclination towards IMF programs or other support programs, then all of a sudden they become favorites of the situation. So anyway, to summarize, stick to, let's say, shorter duration, commodity-linked bonds that are true of the region, and also, if you see stories of support mechanisms such as IMF or other multilateral facilities.
Persella, thanks a lot for your comments, and I'm really looking forward to meet you later at our conference in person.
Thank you.
All right, then let's move forward. Please meet Gonzalez, Corporate Finance Manager of Regional Casa de Bolsa, with the overview of Latin American bond market. Jan?
Good morning or good day to everyone, depending on your time zones. I'm so glad to be here. Thanks for having me. It's a pleasure to share with you a little insight on what is the Latin American bond market. So I will share my screen, and please confirm if you can see it.
Yeah, perfect. Thank you.
Okay, so let's dive in. So here's a map, which actually is a heat map. We can give you a hint of where most of the bond market in Latin America is concentrated. A disclaimer here is I will be talking about mainly the domestic bond market. I didn't take into account all the bond issuance in foreign markets, so we'll be talking only about local bond markets. So I think it's necessary to have some kind of historical context in order to understand the late development of the Latin American bond market. So I'd like to present you a few policy and structural impediments that are well documented in the BIS paper number 36 by Serge Janot and Camilo Tovar first, so we can have some context before understanding what happened and what is happening in Latin America. Next, I will be presenting you with some stats about countries, the bond market by country, by region, comparing with the GDPs in order to have some measurement of the relative size of the market. We will talk briefly about what factors are the main drivers for the market. And I will be closing the presentation with what lies ahead, not before talking about where to invest, presenting you with the largest sectors in which the bonds are concentrated. Okay, so what did it take so long for Latin American bond markets to develop? Well, a few pointers here. First of all, a poor record of macroeconomic management. This was reflected in high fiscal deficits and inflation in previous years, which has deterred governments and other borrowers from introducing standard long-term debt securities in the domestic markets. In this respect, it is well known that high inflation and volatility, it's always a big impediment to the development of the bond markets in emerging economies. An absence of a broad and diversified investor base until the late 90s, institutional investment played only a very limited role in most emerging country markets outside of Chile, which is, let's say, is the most developed country in the Latin American bond markets. Even where institutional investment was sufficiently developed, restrictions on asset holdings, particularly on lower rated or private sector securities, have narrowed investment opportunities. We have also primary markets inefficiencies. These have increased the implicit cost of domestic issuance, such as, for example, lengthy registration procedures and uncompetitive underwriting agreements. Other factors like capital controls were also impediments. This obviously made it very difficult for foreign investors to access to buy bonds from Latin American countries. We also had regulatory restrictions that impeded the development of secondary markets, which, as we all know, are the liquidity measure of other bond markets. This had created excessive volatility, which had exacerbated the liquidity risk for traders. These restrictions, like, for example, interest rate controls, investment regulations, have inhibited actually active trading. Transaction and withholding taxes are also impediments that Latin America were facing for a long time. Moreover, market liquidity has been constrained by the lack of a proper infrastructure for trading in government bonds and the lack of availability of repos and interest rate derivatives. And finally, a lack of infrastructure. Many countries have lacked an adequate infrastructure for the development of the private sector debt securities. For example, this is the most pressing issue. This was the most pressing issue, the lack of long-term government benchmarks, which will use to the pricing of corporate liabilities, insufficient protection of property rights, lax accounting standards, and poor corporate governance. Additionally, the limited penetration of rating agencies has constrained also the analysis of corporate credit risk. Well, these were some of the troubles that Latin America faced. So, as stated, well-functioning corporate and government bond markets require pretty good infrastructure in order to work properly. And these are not conditions that develop overnight, so it did take some time to develop for the Latin American bond market. That being said, let's dive into the structure, the proper structure of the market. So we have here that we can see that the sovereign debt is the biggest size of the pie with an 80%, followed by an almost 20% of corporate bonds and a very low percentage of municipal bonds. Regarding the size of the markets, we can see that this probably comes as no surprise to you, everyone, that Brazil is the largest market with $602 billion, followed by Mexico, Chile, and Colombia. And if we have in consideration the size of the market as a percentage of their GDP. We can see that Chile, Colombia, Mexico are the three main countries, and this has more to do with the size of the GDP of Brazil, the size of the economy of Brazil, more than with the size of the bond market. Finally, in number of issuers, we have always fixed income issuers. We have Brazil leading by a large distance in front of Argentina, Mexico, Ecuador, Chile. Okay, if we take into considerations the sovereign bonds in one side and the corporate bonds, we still have Brazil as a main issuer, followed by Mexico and Colombia. At the top three, and corporate bonds, Brazil, Chile, and Mexico. The sovereign bonds total for the Brazil issuance is 420 billion, and for corporate bonds is 179 billion. Here we can see the distribution as a percentage of the total issuance by sector, and in which we can see that Ecuador, Chile, and Panama have the most share of corporate bonds compared with the total issuance, and Argentina, Colombia have the more sovereign bonds in comparison. We have corporate bond markets as a percentage of GDP. In this slide, I take into consideration only corporate bond markets and the corporate non-financial, which is an interesting phenomenon in Latin America. A lot of corporate bonds include banks emissions, domestic bank emissions, minus Brazil. Brazil has like $1 billion or so of dollars issued domestically, but most of their financing of its banks, Brazil comes from outside with something like 36 billion issued in foreign markets. So as we can see, the corporate non-financial has Chile, Brazil, Panama, and Bolivia as the main issuers. Okay, so where to invest? And this is a simple tree map taking into consideration all the USD equivalents, taking into consideration both domestically issuance in US dollars and in domestic currencies, and all taking into consideration the US dollar equivalent. So we can see, as I was telling you, the banks had most of the share of issuance with a 31.2%. This is the total market. Then we'll see some selected countries, the major countries, to see what are the main difference in this composition. We have the power sector, which is mostly electricity, and leasing and rental. This part of the tree map is heavily biased towards Brazil leasing and rental industry, as we will see in the next tree map. Next, we have some government agencies, water, heat and gas, transportation, support activities, and wholesale and retail. These are the, let's say, the bigger sectors in the industry with regarding their bond issuance. So let's dive into Brazil and Chile. As I told you in the slide before, the leasing and rental constitute at 21% of the total issuance by Brazil. Power, it's obviously the main share of the tree map. We have other sectors, transportation, other financial institutions, mostly are securitization companies. They have a large portion of the share too. And transportation services, water, heat and gas, and some minor sectors. Regarding Chile, we can see that more than half of the issuance correspond to banks, other financial institutions, and there are minor other sectors like wholesale, retail, power, railroad, transportation, and so on. Continuing with the major countries, we have here Mexico and Colombia, in which we can see that also banks have a major share of the pie, the tree map, with banks in Mexico accounting for 30% and in Colombia 32%. In Mexico, we have other government agencies. This is a An interesting feature of Mexico, they have a lot of other government agencies that have a range of aims, from housing to infrastructure, roads, etc. We have oil and gas extraction, microfinance, and other financial institutions. And in Colombia, we have banks, other financial institutions, as Brazil is mainly securitization companies, water, heat and supply, and power at 17%. Okay, so let's close this presentation with some of the main features of Latin American bond market. So what are the main features of our market? The size. Domestic debt markets vary widely in size. As you have seen, the size of Brazil, Mexico, and Chile are the biggest issuers compared with other countries that in size-wise. But if we take into account the stock of debt with relation to GDP, Chile, Colombia, and Mexico have the biggest shares. It has to be said that, as I told you before, this has more to do with the size of Brazil's economy than with the size of the bond markets. Another interesting feature of Latin American countries is the size and of the sovereign debt, which, as you could see in the first slides, it accounts for 80% of total outstanding bonds. Another interesting feature in the last few years is the extension of the maturity structure of the government in local currency. Most countries nowadays have issuance of 30-year government bonds. This allows to construct a reference curve in order to price properly corporate debt. So the investor has at least a reference curve in order to price properly their portfolios. Another interesting feature is secondary markets. As we all know, this is a parameter for liquidity. The general consensus is that it has expanded to really healthy levels, providing investors with a sure way to make their assets liquid anytime. So what lies ahead for Latin America? We have two kinds of factors, endogenous and exogenous, that have had a strong impact in which was in the history of Latin America, and this continued to be the case. So, for example, in endo factors, we have stabilizing monetary policies. Most of the countries have inflation targeting regimes. Fiscal deficits are always hard to keep under check, but more or less we can say that we have control deficits and flexibly exchange rate regimes. In exo factors, we can quote high commodity prices, at least in the last few months, economic growth, and expectations of further currency appreciation for the region. Finally, as a result of this better environment, domestic interest rates are determined more by local economic developments than outside factors, especially in domestic currencies. And foreign investors now are looking to take important positions in Latin America fixed income assets as a part of the diversification strategy in order to seek for higher yields in a world that in the recent past have been trying to maximize returns in an environment of very low interest rates, especially during the COVID months. So that's all that I had to present to you. Thank you very much for your attention, and I'm here to hear your questions, if you have any or whatever.
Yeah, Jan, thanks a lot for your overview. You're 100% correct that Latin American bonds take, I would say, maybe huge or big part in our portfolio of investors worldwide, at least with whom I'm speaking with, portfolio managers from different locations. And even private investors, they love Pemex, Petrobras, or any other, of course. So I would like to ask maybe a little question. So, in terms of kind of forecasts, what are the forecasts for Latin American market amid rising inflation? And what alternative sources of financing can company use to develop in the current environment?
Okay, great question. I think inflation is a question that applies to most countries nowadays.
True, but how LatAm will face it?
Yes, so I can tell what is happening right now in our country. Inflation is high. We have an inflation target regime that has as the goal 4% of inflation, and we have 7.9 in the last month. It's well outside of the bands of what the central bank is seeking. So it's the central bank is doing what everyone else is doing. It's raising their reference rates. We went from 0.75 last year, and the central bank started to pump the rate, and we are now at 6.5 from 0.75. Also, we have some instruments called Letras de Regulación Monetaria, which is an instrument that the central bank uses especially with financial institutions in order to withdraw liquidity from the market. These are the rates for these instruments is in the last is a monthly auction, and the rate, the average rate in the last year was something like 5-6%, and the last two auctions were, for example, 9%. And these are instruments that matures at a year and a half, very low. And these are even higher than sovereign bonds issued are at maturities of 5 years, 7 years. So you can see the measures that the central bank is taking in order to contain inflation. As per the other question, which has to do with the means of financing for local companies, these are challenging times, but it really depends on the sector. We are working from Regional Casa de Bolsa with some companies that are real economy, for example, rice producers and fertilizer importers. They are, in the case of the rice producers, they are facing interesting prices. They are looking to expand their capacity, their output capacity, in order to take advantage of the prices now in commodities, especially in rice. And with the other, we are talking about, and this is another, I don't know, it will be interesting to know from the other speakers, the fertilizers price are being a thing right now. It is talking about because it can impact the prices of food. Depending on who you are listening, food prices could double in a few years or even in the short term. Mm-hmm. So these companies that import fertilizers, and which probably they will face higher prices, and they don't have the space with banks to finance that import. So we are offering them some the opportunity to become an issuer of fixed income in the market. So that will be another complementary way of financing regarding those specific two sectors, right? Food production and fertilizer importers.
Okay, well, thank you very much for mentioning another sector. It would be curious to use our bond screener to check what kind of markets and what kind of yields are in this sector. All right, thank you so much. And let me pass the floor to our next speaker. So Artem Kormilitsyn, he's the CEO and head of Capital Markets Asia Pacific at Gazprom Bank Financial Services and Hong Kong. Artem, so you'll be giving us the overview on the China onshore bond market, right?
Right. Thank you. Thank you for introduction, Lana. Very happy to be here and participate again in Cbonds conference. I hope there will be one day when the conference will come back to Hong Kong, and we'll meet up face to face again. Let me share the screen. Let me start with my presentation, and I would like to start with a few observations. So global investors obviously start to looking to diversify their portfolios, to diversify their risk. When you have the situation when the yields are very low and the inflation is running very hot, you start looking for some safe havens. And in our view, both CNY as a currency and China government bonds as the most liquid CNY denominated instrument provides quite safe investment and a good pickup in real terms, and also it's a good carry trade. So let me start. So basically, again, any global investor should start with thinking, okay, if I want to play local currency play, I need to get a view on the currency first. So let's start with the currency. So here's our expectations of the CNY, US dollar CNY FX exchange rate. And we expect that the CNY will be slightly weakening going forward in Q2 to Q4. This weakening obviously is coming mostly due to the US dollar, US Treasury yields picking up, and the global currencies are all under pressure, and CNY is not an exception. Our forecast is slightly, we see CNY slightly weaker than the consensus, the median consensus, and we expect the CNY weakening from current 6.37 to 6.4, 6.45 in the next 3 months, and weakening further to 6.5, 6.55 towards the end of the year. Again, this weakening is not, a drastic one if you think about it compared to other EM currencies, and the reason for that it's largely counterbalanced by the factor that China running a big trade surplus, and there are a lot of inflows in CNY portfolios. So, as well as the PBOC stance and PBOC preferences on CNY strength, which we will talk a little bit further. So today we will take a look at the key support drivers for CNY, as well as the depreciation drivers. We'll think about it, what PBOC prefers to, where PBOC prefers to see CNY, and we'll discuss the midterm outlook. Okay, let's start with the key support drivers of CNY strength. So Chinese market consensus sees GDP growth at 5.1 for 22 and 23, year 22 and 23, which stacks up well above the IMF forecast for developed markets, which stands at 3.9, and it's better than the average for EMs. For 2022, Chinese government set quite an ambitious target of economic growth around 5.5%. They call it around 5.5%. And in our view, anything which is above 5% will be quite supportive for CNY. Another key driver is the current account balance. It's quite strong. Last year, China had a record trade surplus of 676 billion US dollars. This year, we don't expect the record number. At the same time, we see that we think that one of the supporting driver in terms of account balance should be the restrictions of overseas travel. As you know, China right now is quite closed for inward or outward overseas travel. So in terms of services balance, which is slightly negative right now for China, we think the fact that the majority of the population will stay in China and spend money there, this balance will be narrowing. So I think we also can account that even if the trade surplus will be slightly lower, the narrowing services balance can actually help the overall account balance. We think going forward, we will see more and more inflows in CNY denominated assets. We will see it in the form of FDI, as well as the inflows in liquid public instruments. In last year, in 21, the FDI rose 20% and reached 174 billion US dollars. Again, don't expect FDI to be as good this year. There will be growth, but probably not as significant. But we see that there could be additional inflows, FDI inflows coming from from the countries of the regional comprehensive economic partnership. It's taking an effect in 2022 this year. So predominantly it's Asian countries. So probably we'll see more FDIs coming from these countries, and that will again support the CNY strength. We also expect that the central government and the central bank will further introduce policies to boost the economic growth and stabilize capital markets. Last two plenary sessions were mostly discussing issues around economic growth, the slowdown and how it should be managed, how to set the targets going forward, what support measures should be introduced, etc., etc. So it was quite economic focused, and the recent remarks from the head of Chinese state, Xi Jinping, was mentioning that he would like to see the stable economic growth, as well as reassured the support of the Chinese government for stable capital markets. So I believe that that will also play out for CNY strength. At the same time, there are quite a few depreciation drivers. For CNY. So the major one is, of course, the diverging monetary policy between China and US. As you know, the PBOC started to start easing policies in January by cutting rates, by cutting reserve requirement ratios, which provided long-term liquidity to the financial system of China. At the same time, we see the US going the opposite direction and beginning the tightening cycle with the rate hikes and the reduction of asset purchases. So when you have this kind of situation, the UST yields are picking up, and the differential, the premium in Chinese government bonds over treasury bonds is narrowing. As it's narrowing, the attraction of the CNY fixed income products are less apparent. So there could be intensifying outflows from CNY denominated products, which again could lead to some depreciation pressure on the currency. Another point is the possibility of softening exports, export growth going forward. That may require for PBOC to take a stance to weaker CNY a little bit to support Chinese exporters. Right now, we think that it is quite possible that the demand shift from goods to service can realize in second half of 2022 with the recovering from all the lockdowns and other social distancing and other epidemic restrictions. We believe that the consumers may shift from goods more towards services, and we also think that a lot of Chinese competitors may come back to the global market, and the competition will intensify. In this case, PBOC probably will have to step in and will manage to weaken the CNY to support the exporters. Of course, geopolitics, yeah, that's another depreciation driver for sure. We cannot exclude the possibility of escalations of tensions between US and China. Right now, there are a lot of points where two countries don't exactly look eye to eye. So at the various points in 2022, we may see the escalation, and this in each escalation, of course, the global investors will probably try to de-risk, and the outflows again from CNY denominated fixed income products and equities could lead to depreciation of the currency. Yeah, and one another hint that CNY actually may weaken in the near term is that there is a historical correlation between US dollar CNY exchange rate and DXY, US dollar DXY index. If you can, as you can see on this chart, the two lines are mostly correlated over the past 5 years, but recently they diverged. So another hint again that the CNY probably could weaken somewhat in the near term to catch up with the to return to correlation with DXY. Okay, what do we expect from PBOC? PBOC is a key player in setting the CNY exchange rate fix. So we see that in first half of 2022, PBOC may actually prefer to maintain CNY relatively strong. And there are a couple of reasons for that. Again, we think that will be in a range of 6.4 to 6.45. The reasons to maintain this strength of the currency is first, it's the mitigation of the imported inflation. and helping local producers to cope with really hot surging energy and commodities prices. So this is reason number one. And the second reason is that keeping the CNY strong also prevents the excessive capital outflows from CNY assets. But this is for the first half of the year. In our view, in the second half of the year, the preference to maintain the strength could be a little bit lower, leading to US dollar CNY exchange rate weakening to 6.5, 6.55 by the end of 2022. We believe that why PBOC may choose to weaken it a little bit. First of all, of course, it's we may see much more aggressive Fed hikes in May and June. Now we're already hearing that U.S. inflation could be in double digits territory very soon, and that probably could push Fed Reserve to be more aggressive in terms of rate hikes. Right now, we see that dot plot indicates 6 more hikes in 2022, up to 1.9% level, and we cannot exclude that May and June hikes could be as high as 50 basis points. So especially if inflation will be persistent and really high. In this case, the outflows of CNY assets may intensify, and that will be weakening the exchange rate. This coupled with the slowdown, which again we see it as a possible case, the export slowdown in the second half of 2022 will probably make PBOC wish to support the exporters, and the weakening of the CNY exchange rate will help them and will bring more competitive advantage for the Chinese goods on the global market. So again, this is how we view CNY in the near term, the weakening, but the managed weakening, and not so drastic, from 6.37 to 6.4, 6.45 in the next 3 months, and going forward towards the end of the year to 6.5 and 6.55 range. Talking about our expectation of CNY in the midterm, we actually quite like this currency. I think the fundamentals are quite strong. So few factors that will support CNY strength in the midterm. First of all, the demand for CNY assets to remain strong. Global investors, they all know that they are underweight China, and that probably will be changed going forward. Chinese government is progressing with a very cautious and sensible policies, monetary policies. So the CNY assets look attractive now and will continue to look attractive in the future. So there will be some redistribution of allocations towards CNY assets. We also believe that there will be a structural shift of FX reserves among the global central banks, and the increase in CNY holdings, our estimate from 2.4 currently to, let's say, 5-6% in the global central banks portfolios will result in $400 billion equivalent of inflows in Chinese bonds denominated in a local currency. Another supporting factor is the economic growth. China GDP market consensus growth right now stands at 5.1% year to year for 21 and 23, which again compares very well to developed markets or emerging markets. There is also aspirations of Chinese government to in a longer term to see CNY as one of the global reserve currency. This also quite supportive factor, and that may come also faster than anyone imagining if eCNY is introduced for cross-border settlements. That will definitely boost the usage of cross-border settlements in CNY, and the demand for the currency will be quite strong going forward. And the last point, yes, it's the potential weakening of US dollar hegemony. We believe that increased diversification of foreign exchange reserves will be happening going forward, and also we think that more and more counterparties globally will start using CNY for settlement of their trades, especially with China, starting with China, and we already heard about
Just a second.
Hi, hello.
Yeah.
Hi.
We lost you.
Yes, you lost me on the most interesting part of my presentation, right?
Come on, share your insights.
Okay, here we go. All right, so, okay, no more about weakening US dollar hegemony, otherwise they will cut me again. All right, now let's talk about the CNY products. So the most liquid one and the most desired by foreigners and loved by foreigners is the China government bonds denominated in local currencies. As of the end of last year, foreigners hold roughly 2.5 trillion RMB of China government bonds, of CGBs, and that is the about 10% of all CGBs outstanding. So it's a decent portion of Chinese government bonds held by foreigners, and yeah, global investors, major global investors, they all love the carry trade and the fact that the yield is quite juicy, even if you take in account the CPI. Chinese CPI actually not that high. In February it was just 0.9% year on year. So it's with 10-year CGBs yielding around 2.8%, you have quite good pickup there. So again, for those global investors who want to diversify their portfolios, who are looking to get into local currency plays, CGBs are quite decent choice. It's positive yielding on a net basis, and it's very liquid. The overall outstanding of CGBs totaling 22 trillion CNY. So it's a big market.
Yeah, totally right. And Asia should be really promising in the next few years for sure. Artem, thanks a lot for your overview. I have a quick question as we are a bit out of our timing agenda. So how do you evaluate the possible political risks of investing in China, and what kind of behavior of domestic market is expected in case of destabilization in political situation?
Political situation, Lana. Look, I don't think that I'm not going to talk about the internal political situation in China because I don't have much view of that. I think it's quite stable overall. So I don't expect any surprises there. If we're talking about the geopolitical situation, yes, I think there could be some points in this year and maybe going forward when investor sentiment will be weakening due to the increase of tensions on the geopolitical scene. But again, if we look at the fundamentals and not on the sentiment, the Chinese government bonds are a very, very solid instrument. So yeah, we could see outflows of foreigners, going forward, but then we will see inflows back. So that will be a sentiment driven, and it will be short term, in my view.
Thanks a lot for your comments. Well, basically, you confirmed what was my expectations. Thanks a lot. And let me pass the floor to our final speaker in this panel, Terry Zhang, the head of global strategy and business management at Pengyuan International. Well, I think we can make your presentation and take a bit time from the break, so no worries, no rush. Please share all your insights with all the calm. Terry?
Okay, thank you, Lana. Thanks for having me today. And good afternoon, ladies and gentlemen, and good morning, depends on where you are in the world. It's really my pleasure to be here today. I always treasure the opportunity to work with Cbonds as it gives me opportunity to directly get in touch with international investors, as well as some other market participants who are interested in China's capital market. In the past few years, I've been sharing my view about international connectivity side of China's capital markets. So this time, I would still focus mostly on Panda Bond, which means the RMB bond issued by foreign entities in China's onshore market. So before I dive into that, I would like to quickly introduce who we are and what we do for those who don't know us. Well, Pengyuan International is a Hong Kong-based credit rating company. We are licensed by the Hong Kong Security and Futures Commission, SFC, since 2012. That's exactly 10 years ago. And we're providing a credit rating on a global scale. And our parent company, on the other hand, is CSCI Pengyuan, a 29 years old domestic Chinese rating agency, mainly providing credit rating on China's national scale. Our ultimate parent is called China Security Credit Investment, or CSCI for short. It is what we call a full credit company that are commissioned by the CSRC, which is the securities regulator of China, and backed by 35 financial companies in China, as you might see some familiar logos on the slide. Okay, so this slide shows our coverage in the pie chart. As you can see, we have quite a diversified rating coverage across industries. And these are some slides, there are some slides looking bigger than the others. Then the top one is the local government, as we cover 23 Chinese mainland provinces out of 31 in total, as well as the government-related entities, followed by property 11%, and banking is 9%, etc. I think the composition is relating to the reality, China's reality these days, that it remains a state capital dominating economy. So the big chunk of the Chinese issuer are somewhat related to the government, if they are not the government itself. And I also quite often got questioned about how do you compare your rating to the rating consensus on the international market. So we have the latest data show that by average, we have a positive 0.25 notch differences against the same credit in the international markets. So despite occasional differences in our credit view, we're essentially using the incumbent global rating scale, which is largely converged across rating agencies globally. And we believe that the incumbent global rating system, even if far from perfect, still providing the market the best available comparability, consistency, and stability point of reference. And we blend our local touch to it. Okay, next. So before I got into the Panda Bond itself, let me give you some quick snapshot about China's capital market. So we have a bit of a context here first. So in this pie chart is produced based on the data provided by the Bank of International Settlement on the outstanding amount of each national bond market. Well, similar to Yan, who presented earlier here, I only captured the local market here, and I excluded the offshore issuances. So from the pie chart, the United States has long been taking the first position over the decades. So now the US have 48,196 billion US dollar outstanding debt, accounting for 43% globally. So second to the US is China. The outstanding amount is 20,578 billion US dollar equivalents, or and if we present the number in percentage, that's 19% globally. And the third place is Japan. The China has actually surpassed Japan to take the second, I would say, the position of the second largest bond market in the world in 2019. And as of now, and there are already about 7% gap in terms of outstanding bond between China and Japan. So however, we do not really expect China's market to grow at a very fast pace in the in the next few years. This is in our view because China is really in the process of shifting gear, adjusting its way of growth, and that would naturally involve, I would say, certain extent of financial compression and deleveraging on the whole system level. Yeah. Okay, so in terms of default, that the default has actually gone down quite a bit in 2021, despite the overall upward trend over the past decade horizon, both in terms of the number of default and the amount of defaulted. And this could be somewhat counterintuitive for some audience, because there have been quite a large number of offshore defaults especially in the property sector. And I remember mentioning about that risk last year on the Cbonds conference, but I guess no one really will anticipate the magnitude of the default cases from that sector. So there are many ways to look at the default cases going down in China. So one is that the Chinese developers' financing has had been somewhat restrained in China for several years already, to various degree, which may explain the incentive for some Chinese developers to move the financing activities offshore. So the whole sector of the property has actually deleveraged quite a lot in the onshore system in a material way. So secondly, there are restrictive policies targeting the sectors like education, technologies in China, and we see that a lot in the news last year. But bear in mind that these are the sector, I would say, they are quite active in the equity market, but they are hardly a backbone sector of the bond market in China. And thirdly, I would say the business culture in China has been shifting quite a bit away from the philosophy of too big to fail. As evidently, Chinese government on one hand has let some prominent name to fall on itself, and on the other hand, the Chinese government is making sure there's no systemic risk. So given that we saw a large number of big name material names fall in the past few years, but maybe less so in the future. About the foreign holding of Chinese bond as of now, the percentage is about 3.5% of 4 trillion CNY, Chinese yuan, by January 2022. The foreign holding level is still low, but it has, if you look at the rate of growth, it has been more than doubled the number by the end of 2018. And there are several important drivers behind that increase. Just to name a few, we have the indices inclusion. So Chinese bonds, the CGB, among the others, have been included in several major global indices in the recent years. And that would naturally help the capital inflow in China. And also you have favorable currency movement as the CNY has been on the high level. Diversification benefits, and a Chinese bond asset is quite, I would say, unrelated to other type of global assets. And the last but not least, the rate gap between the US and China, which can be gauged over the 10 years treasury. I think we have a very useful slide from Artem earlier. So okay, let's dive into the Panda Bond. So first, let me start with some terminologies of Chinese cross-border bonds, which may be confusing for some because there are quite a few. So on the top left is Panda Bond, which basically means the foreign or offshore entities issuing bond in China, denominating in CNY. And on top right, you have Dingshan Bond, which means the entities from all over the world, including the ones from mainland China, to issue renminbi bond in the offshore market, or in other international market like London or Frankfurt. And the third one on the bottom left is Kung Fu Bond. It is a term that was first invented by Bloomberg. Is referring to the Chinese offshore US dollar bonds. So basically Chinese issuers issuing US dollar denominated bonds in the offshore or international markets. So last we have Yulan Bond, which represent a new development of China's opening up. It refers to the Chinese onshore issuers issuing bonds domestically in US dollar or in Europe at the Shanghai Clearing House, which is now connected to Euroclear. So that means this is a domestic bond denominated in foreign currencies, and also targeting the international investors' appetite. Yeah. It's often for the market to look at a Panda Bond and Dingshan Bond together because they are both renminbi denominated instruments. In most of the time in history, we see Dingshan issuances have been higher than the Panda Bond issuances, except the period of 2000 2016 to 2017, which is a period I use a yellow circle to circle it out. So during that period, things runs the opposite. Is possible caused by the rate of reversion between during that period, and I will cover in the next slide. But either way, no matter dim sum or Panda Bonds, they haven't developed into a major asset class compared to others yet, in my view. So still, there are a lot of room for both asset classes to grow. So here you can see the average coupon comparison between the dim sum and Panda Bond. So when Panda Bond was picking up, the cost of dim sum issuances become materially higher than the Panda Bond issuances during the period of 2015 to 2017. So however, after 2017, the cost of issuing Panda becomes more expensive. But interestingly, by the end of 2021, the cost of issuing dim sum become more expensive than issuing Panda. So this is something new after 5 years. Could it mean that it is now the good timing to issue the Panda Bond for international issuer? I think that's something up for discussion. So this chart shows the background comparison among the Panda Bond issuers. So normally when we speak of Panda Bond, people will think about international names, IMF or Mercedes-Benz, but actually there are a large number of Chinese offshore entities resorting to this instrument. So these issuers typically incorporated in the offshore center like Hong Kong, and they will typically have a parent company based in onshore. So when we look at those numbers, this cohort will reach sometimes as high as 50% of the total Panda Bond issuances, and they are a material contributor to Panda Bond because those flows really help to smooth out the process of the cross-border bond transaction, in my observation. Well, this graph just quickly show the geographical distribution of Panda Bond issuers, and we have a lot of issuers from Asia, Europe, and as well as the United States. So in terms of industries of issuers, the biggest pie represent other corporate names, which is more than half among all. Other than that, you have developers is 20%. You have FIs, banks, 14%. LGFVs, which means local government financing vehicle, which is a unique animal from China, which represent 2% of the share. Sovereign 4% and supranational 5% overall. So the value of issuance is another dimension to look at, and we used to, in daily communication, we use the term China's onshore market a lot, but in reality, there is no unified capital market yet. There are interbank markets, which has 90% market share, and there are exchange market, which consists of the Shanghai Exchange and the Shenzhen Exchange. As before, the interbank market attracted most of the Panda issuances. So, however, the exchange market has been putting on a lot of efforts trying to attract international issuers to issue Panda Bond in the exchange market. Making arrangements, policies, and guidelines more friendly. And also, it's worth to mention that the China has been working on connecting those two markets, which is the effort in our expectation will ultimately lead to a unified national domestic bond market for China. So this is something we should look forward to. But as of now, for Panda issuance, they still have to deal with a different set of rules and offices. Yeah. And also, very importantly, there have been some regulatory update about Panda Bonds. In May 2020, the Financial Stability Committee of the State Council of China has issued a bond transaction guideline for foreign government-related entity and International Development Institute. So this move is aiming at optimizing the disclosure requirements and iron out the transaction detail for Panda Bond issuances in the overarching manner. And in December 2021, PBOC and SAFE have jointly issued a request for comment, a rule of proceed management for foreign entities issue bonds in China. So this is a very important piece, which is currently still in the process of requesting for comments. But there are, some pretty exciting development. For example, you will make improvements on the proceed management, so use of the to use a unified account for domestic and the foreign currency assets, and also there is a registration-based free proceed repatriation process, which is to be established. This has been a sticky issue for a lot of global issuers to move the capital raised in the domestic China abroad. And also, last but not least, this piece will encourage the use of renminbi, the Chinese currency, and the development of the currency risk hedging tool and established practices. So other than that, China Security Regulatory Commission, or CSRC, made a response to CPPCC's capital market-related proposal during the National Two-Session meeting this year. The CSRC has made it clear that they have been working on new rules for the Panda Bond issuances in the exchange market. For example, to put in place a detailed guideline for example, the scope of permissible issuances, and the registration requirement, accounting standard, intermediary management, and the foreign currency management, etc. So to sum up to this page, I myself is one of the early practitioner in the field of Panda Bond space, and I did come across a lot of criticism, or complaints, or frustrations from the global investor side in regards to the opaque or the lengthy issuance process in China, and I sympathize that. But I also observed that the moderation of the policy and the baby steps, forward-looking baby steps, like the Chinese government have made. So as of today, most of the application will still have to be reviewed by Chinese authorities on a case-by-case basis. So each case would have its own sticking points, and I do hope to see some material progress from the market infrastructure, or the policy, or the legal environment, or the accounting standards in the next 2 to 3 years. So to allow the global issuers to seize the access to the second largest bond market. It's also worthy to consider, I would say, obtaining and maintaining credit rating in advance. So when a capital market window opens up, or when the regulatory window opens up, you could move quickly. Okay, let me stop here on my contact page. I hope you found this presentation somewhat useful, and I left my mobile or WhatsApp and my email here. And for those of you who happen to have the WeChat, feel free to scan the QR code and connect me. Like I said before, it's our strategic focus to stay on the front seat of China's capital market upgrades and opening ups. So we do strongly want to meet the demand of global market participants by leveraging our expertise in China. So if you have any question about the practices, the situation, or if you need the connections in China, and my team and I myself will be more than happy to provide a support. Never mind to free write us if it helps you, because speaking from my experience, I also benefited from talking to the global market participants for new information, new ideas, and new angle to reflect on ourselves. Well, thank you. Lana, back to you. Thank you.
Yeah, Terry, thank you so much for your overview and especially for your last slide, because the placement on the Chinese markets are rather difficult topic for us, and sometimes it is really not clear. So, well, just a quick question. How complicated is the issuance process for foreigners for the first time, and does it get it a bit easier with the next issuances? Do you have any updates on that point?
Well, in my observation, if the first step is the most difficult one. So once you have the first step, it's naturally a lot more easier to run the process either in the interbank market or either in the exchange market in China. So the key is really about the first step in China, because this is something I would say it's still the hurdle. China is a country that's running a capital control. The capital account is not opening up, although they are making progress towards liberalization. But the capital account control is a reality that I would say we will have to live with. Even for the Chinese people, we will have to live with the reality in this era. So going around that, I think the Chinese regulators, various Chinese regulators, has been trying to put policy forward, trying to make the process somewhat easier for the global issuers. But however, at this point, I don't think the highway has been built yet. So, like I said in the presentation, the Chinese the regulators is still reviewing the application on the case-by-case basis. So if that dynamic hasn't changed, I would say communication with the various regulator in advance is paramount to the successful Panda Bond issuances. And like I said earlier, there are progress in terms of putting the regulation in place. And I do think we're going to see something concrete in about 2 to 3 year horizon. But personally, I don't think this year things will move particularly fast, because this is a year that China is going to change its administration team. So there's going to be a lot of reshuffling, which is has already been taking place as we speak now. So things are less predictable or effective compared to before. Yeah, this is my observation. I hope this is helpful.
Yeah, definitely helpful. All right, let me probably finish this panel. I would like to say big thanks. You did a fantastic job with the making very diversified research on each market with the emerging market. So thank you each speaker personally, and I really wish to see you in our next conferences and even in person. It would be a great pleasure. Then we'll have a 5-minute break, unfortunately, as we had to discuss lots of issues. Then I will pass the floor to my colleague, Alessandro Lombardo. He's the head of client relationship department at Cbonds, and we'll have more global overview of high yield, because emerging market, it's general the thing which we formulate, but we are in any case chasing for high yield bonds mainly, and let's see what kind of the picture we have in terms of high yield in global coverage. All right, see you in 4 minutes, and thank you very much for making it. See ya.